Hello, everyone. Thank you for joining us today for our webinar, Understanding Key Forms of Relief for Healthcare Companies in Response to COVID-19. We'll have a number of presenters today from McGuireWoods that you'll hear throughout the presentation. Amber Walsh, who's a partner and a chair of our healthcare group. Gerald Thomas, who's a partner and chair of our tax group. Holly Buckley, who's a chair of our life sciences industry team. Tim Fry, who's an associate with McGuireWoods, and my name is Kayla Marty, and we'll be working through the various topics that are impacting all of your all's businesses in connection with the current pandemic. So I know a lot of you are going to be familiar with many of the key topics that we're going to be discussing. We've been actively publishing alerts, and I know you've seen it on the news probably every day. So in the programs themselves, this is really going to be a 101 presentation so that you all can familiarize yourself with the potential programs and implications of them. We're, of course, happy to follow up on any additional questions that we see throughout the program, and we'll try to address them as we go along. If you'll please submit any questions you have in the Q&A chat box, we'll be monitoring that, and there will also be a question and answer portion of the presentation at the end. So in addition to the 101 presentation of the key programs, we will also be addressing as we go along various M&A implications to each of these programs. So you all have probably heard and seen through alerts that there's going to be a significant amount of interplay between each of these programs as we move forward. It's going to be very important that as a participant in those programs, but also as potential purchasers of businesses, or sellers of businesses, that you're familiar with how they operate with one another. We're also going to be mentioning throughout the program some tidbits of advisable diligence points to consider as you look at future sales, either yourself or as a buyer. And then there's obviously going to be a number of new language points or things to consider with respect to transaction documents or contracts that you have as we continue to move forward with COVID-19. So today's agenda are a few key programs. These are by no means the only programs that are outstanding, but Amber is going to talk a little bit about the SBA-backed lending programs, which I know that everybody is quite familiar with or likely is familiar with. I'll spend some time talking about the Main Street Business Lending Program. Holly is going to address the accelerated advance payments from CMS, and Tim is going to address a number of grants by HHS and other hospital relief through Medicare Payments. And finally, Gerald is going to address the key areas of federal tax relief, as well as some of the implications of each of the other programs on certain tax policies. So with that, Amber is going to go ahead and get started on the SBA-backed loan program.
Thank you, Kayla. So I will be talking about both programs that are backed by the U.S. Small Business Administration. That would be the Paycheck Protection Program, referred to as the PPP, and the Economic Injury Disaster Loan Program, which has gotten a little bit less attention than the PPP, in part because it is available to a smaller universe of applicants and doesn't have quite as attractive terms as the PPP. We have been spending probably more time addressing PPP issues for our provider clients than addressing many of these other relief programs, largely in recent weeks because of the timing and because the very attractive nature of the PPP. This is the program that has the extremely attractive full forgiveness component, but also requires some pretty heightened standards on applicants for ensuring that they are both eligible, but that they are using the funds correctly to put them in a position for true eligibility for forgiveness. So it's a really high standard on the borrower applicant, but it's a very attractive program. And that's why providers want to be very sure that they understand these different terms and are properly documenting once they do apply. I've been thinking about this in about 3 phases, which is your determining eligibility phase that a provider will go through before they apply. During that eligibility phase, you're also going to want to make sure that you understand the program and what you're signing up for. Then there's the application phase, which is a little bit quicker. But then now many providers are moving into that 3rd phase, which is planning for forgiveness. So providers are at very different stages depending on whether or not they have made the choice to submit and whether or not they've received their funds. But there are providers who are at that stage of having been funded and who are moving on to that forgiveness phase. Many of you have heard that the initial $349 billion originally designated for the PPP has been depleted, or at least applications have been halted. But as most people are acutely aware and following on probably an hourly basis, lawmakers are working frantically to have an additional round of funding. And it appears that we are very close to a deal announcement. In fact, before this webinar is over, we may have the terms of a deal announced. Lawmakers are still working through the details. So I think we are all working on the assumption that there will be an additional round of PPP funding such that this eligibility component remains very applicable for those of you who have not yet made that decision. So let's talk about that eligibility. The eligibility rules can be very complex for larger healthcare organizations or those that have a particular type of relationship that makes determining whether or not they are a small business, small enough to be eligible, really applies. So those rules are complex. We will not go into those here because, as Kayla described, this is more of a 101, but just a few points of which you should be aware. If you are a healthcare provider that is small to medium size, well below 500 employees yourself, then unless you have a significant management relationship or your organization is part of a joint venture that may have a hospital partner, et cetera, you will probably be eligible because your employees and your revenues likely will not be affiliated with another organization such that you are higher than that 500 employee number. However, I simply want to encourage you to be very thoughtful about that because it is not as simple as saying we have fewer than 500 employees, we are under the revenue limit for our particular specialty type provider. Instead, you have to think about your management co-owner relationships to determine whether or not you really are part of a larger organization that would make you less likely to be eligible. Let's move off of that, though, because as I said, those rules are pretty complex, and talk about the real terms of the loan. The loan amount for which you may apply is the greater of 2.5 times monthly payroll expenses or $10 million. The process for applying is actually fairly simple. It is a short application, and it is not a significant underwriting process. However, you do need to be spending some serious time in the calculation of payroll. That is where we see providers raising the most questions at this application stage and making sure they're calculating payroll correctly. There's detailed instructions on the back of the application, and we at McGuireWoods are happy to answer any questions you have about how to properly calculate payroll for that loan amount. Once you are granted the loan, the terms of the loan are that it is a 1% interest loan. It is unsecured, so no personal guarantees, no liens on assets, et cetera. It is a 2-year loan, and the first payment is not due until 6 months following funding. So not following application, not following the note, but following funding. Once you've moved out of that application and funding phase, now you are moving into the forgiveness phase. And that is where many providers are just now finding themselves. These loans are just now being funded. And I need to say from the beginning that we will continue to get guidance. We expect significant rolling guidance on some of the elements of forgiveness. The forgiveness process will not start for several more weeks, but when it does, many providers are going to have questions, and we're happy to answer. We're going to give you just a few of the basics here, though. The loans are 100% forgivable if the recipient documents the use of the proceeds on these eligible expenses in the 8-week period following loan funding. Payroll, which includes salary, wages, vacation, etc. Mortgage interest, so long as the mortgage was signed before February 15th. Rent, as long as the lease was in effect before February 15th. And utilities, as long as the service began before February 15th. Now, many of you are already facing questions on this. You can anticipate questions if you yourself are not in that phase yet. These are the nuances that we're happy to help address for you. One example is, what if I don't have a written lease? Another example is, what if my landlord was so kind as to defer rent? Those are the types of questions we are happy to answer for you so that you can get that 8-week period calculation correct. But here are a few other limitations on the forgiveness component. The number of employees. The whole purpose of these loans is maintenance of workforce. The loan forgiveness will be reduced to the extent that a recipient reduces your full-time employee count. However, there is a rehiring option. So the recipient of a loan has until June 30th to restore full-time employees and salary levels. Now, of course, there are going to be various additional nuances to these questions too, depending on whether or not your staff wishes to come back to work. There are several different nuances in there that we can help you work through, and in some cases are addressed in some of our alerts. Another limitation on forgiveness is a reduction in salary and wages. The loan forgiveness will be reduced if the recipient decreases salaries and wages by more than 25% for employees that made less than $100K in 2019. And then on the non-payroll costs, no more than 25% of the loan forgiveness amount is expected to be attributed to non-payroll costs. And that goes right to the calculation. If you think about it, there are two different calculations, right? There is the calculation of the loan amount that is based on 2.5 times your monthly payroll expenses for the vast, vast majority of providers who will not hit that 10 million cap. But then it is a completely separate calculation as to what may be forgiven. For some providers, that amount will be pretty darn close to the same. For others, it will not. And so that 25% threshold is intended to be an indication of what really SBA and Treasury expect you to be applying for forgiveness. That's how those employee and staffing numbers all work together to derive at that no more than 25% of the loan forgiveness is expected to be non-payroll. Now, the process of forgiveness, it is not automatic. Recipients should be documenting all expenses, and then they will apply to the lender for forgiveness in a TBD process. Again, forgiveness is not starting yet, so providers still have some time to prepare themselves now, but really won't be doing that application until down the road. The lender then has a 60 days, which will probably feel interminable to many of you, to determine whether or not and the extent to which the borrower qualifies for forgiveness. So we're really advising good documentation now. Many providers are funding those PPP loans into separate accounts that will enable them to more easily do the record-keeping component of this, even though that particular step is not required. Last couple of notes, forgiven amounts are excluded from gross income for federal tax purposes. To the note of how these interplay, before I do, just a couple of quick minutes on the second SBA-backed program. The recipient is not eligible for the refundable employee retention credit, and if you have deferred the employer portion of the Social Security tax obligation, then that will be due once your loan has funded. You are no longer eligible to defer it, and so you'll have to go ahead and pay that. Lastly, how it works with the economic injury disaster loans. There's a little typo on that slide, sorry about that. If the recipient had previously received an EIDL prior to the PPP funding, and again, those EIDLs, there's a smaller subset of you who have received that. If the EIDL was not used for payroll, then the recipient borrower may refinance the EIDL into the PPP loan. But a lot of EIDLs came with a $10K advance payment that was completely forgivable. If that happened, then the PPP loan would, forgiveness portion would be reduced by that $10K. By contrast, if the EIDL was used for payroll, the recipient must refinance the EIDL into the PPP loan. That will increase the total PPP loan, which is not necessarily a bad thing because there are many more attractive features of the PPP, and there's a sample calculation in the application to walk you through that. Recipients of the PPP loans can get all the other relief packages other than those two tax components I mentioned. And I'm just going to spend 1 minute before I turn it over to Kayla on Main Street loans, 1 minute on the economic injury disaster loan program. As I mentioned, this is the second of the SBA loans. It is less attractive in the terms, but still was a godsend to many providers. And it was available sooner than the PPP program was. The basics are the aggregate funding was $10 billion, so a lot fewer dollars designated. But again, as with the PPP, we are expecting a round two of funding for that loan program as well. Loans were available up to $2 million. I should say are. We're assuming this is present tense still. Loans are available up to $2 million for applicants in disaster-declared counties or contiguous counties who show substantial economic injury from COVID-19. It's a bit of a longer underwriting process with a smaller available borrower set who will be able to receive those loans. And the terms are different. 3.7% for-profit recipients, 2.75% for nonprofit recipients. There are no additional fees. It is unsecured with no guarantees, but the repayment is going to vary by applicant. So there's a little more variation built into this program. I mentioned a $10K forgivable advance payment that is often given during the pendency of the application, which is forgivable. But there is no other forgiveness component to these loans, which is why they have not gotten nearly as much attention as the PPP. And lastly, recipients of an EIDL loan can receive the other relief packages, including the federal tax relief. But I just do remind folks about the PPP interplay that I mentioned earlier. So with that, I'm going to turn it over to Kayla Marty to talk about a different type of loan program, Main Street Business Lending Program, and encourage you all to raise questions in the Q&A and come to us with any questions about the loan programs I just mentioned.
Thank you, Amber. So the Main Street Business Lending Program is a good transition from the PPP because I imagine many of you on the phone have gone through the process of considering a PPP and may actually not be eligible for it due to the size of your entity from an employee standpoint. The good news about the Main Street Business Lending Program is that it provides some much needed relief to businesses that are over 500 employees. So it is administered by the U.S. Department of Treasury and the Federal Reserve unlike the PPP program, we have significantly less information about exactly what the terms and conditions will look like, but we do know that the aggregate funding is going to be $600 billion under a number of different programs, but there's really going to be two that I think most people on the phone today are going to be concerned about. So the first is the Main Street New Loan Facility, and that's only going to be eligible for, as it would suggest, new loans after the first and a half week of April. And then the second is a Main Street Expanded Loan Facility, which is also exactly how it sounds, expanding current facilities that were in place prior to the implementation of the Main Street Business Lending Program. So there's a couple of positive facets of these programs, which we'll go through in greater detail, one of which is it has very low interest rates for the most part, but there are some drawbacks as well. It is not forgivable like the PPP program, so it's not quite as attractive, but it does have a lot larger number of eligible borrowers, and it has a significant number of eligible lenders that probably many of you all are already working with today in your current relationship. So first, let's talk about the eligible borrowers. There is no minimum number of employees for people to apply for this loan, but there is a maximum. So you can either have 10,000 employees or $2.5 billion in 2019 annual revenues. It will be the lesser of those two standards, so just keep that in mind as you're looking at being potentially an eligible borrower under either of these two loan programs. The other element, which is usually not difficult for people in the healthcare space, or healthcare provider space, I should say, is you have to be organized in the U.S., have some significant domestic operations, and you do have to have a majority of your employees in the U.S. Next, for eligible lenders, because we may have just a couple of those on the phone, you have to be a U.S. insured depository institution, a U.S. bank holding company, or a U.S. savings and loan company. So for the number of, healthcare providers on the phone that may work with middle market lenders, you just need to be really scrutinizing who they are to make sure that they fall under one of those categories if you're looking to participate in this program. Another asterisk on participating in the program, you need to be very aware of the current lending relationships that you have. So you're going to want to look under your current loan facilities to make sure participation is permitted. And even if one of your entities, especially if you have a number of affiliates, are not credit parties on an existing facility, they may still be restricted in some ways under an affiliated loan facility. So you just need to take a look at your existing credit relationships, approach your existing lenders, and have the discussion about being potentially interested in these programs to see, number one, if they are an eligible lender, and then number two, if your current loan facilities would permit participation. So just a little bit of distinction between the two programs. You may only participate in one of the two programs. One is obviously for new loans and the other is to expand existing loans. For both of them, the loan minimum is $1 million. There has been extreme scrutiny over that in the past week or so. The Department of Treasury and the Fed had a comment period that closed last Thursday about the terms and conditions that they previously released about these loans. We understand that there were approximately 2,000 comments that were submitted, and many of them did focus on this principal amount. So it's possible that when additional terms and conditions are released, that this number may be being reduced based on the number of comments that came out, but we will wait to see there. And then the other question we've received from individuals is, what's the maximum principal? So you'll see here on the slide that we've listed the various tests that are defining what the maximum principal amount is. For many healthcare companies, we have found that where the rubber really meets the road on whether or not they can participate in these programs are in the leverage ratios that you will see here. So the leverage ratio for the new loan facility is 4 times EBITDA, and for the expanded loan facility is 6 times EBITDA. So just keep that in mind when you're looking at your potential participation. Another positive aspect of these programs is they are unsecured for the new loan, and there's no expanded collateral requirements for the expanded loan facility. So that, again, is a very positive element of these particular programs that may not be eligible in some of your current facilities. And last, just some key terms to think about. This is by no means all of the loan terms. They are very complicated. We can send out to anyone who reaches out the terms and conditions that have been published on the Federal Reserve's website if you need to find those. If not, you can obviously Google there. But these are the key restrictions. So the use of the proceeds, we've received a lot of questions about whether or not they can be used to refinance or repay existing debt. The answer to that is no, that is not a permissible use of the funds under the current terms and conditions. You also are going to have to certify that you actually do need the financing due to exigent circumstances. So when using the funding and considering how to use it, you should be thinking about what you need the financing for and whether or not it truly is due to COVID-19. It's probably going to be very difficult for a new entity, for example, that wasn't in place prior to the time of the loan to receive any portion of this funding, but it's going to be a very fact-specific analysis on what you can use the funds for and whether they meet that criteria that's listed here on this slide. Another key term is the maturity is 4 years. Another positive feature is the amortization and the interest. Both can be deferred up to 1 year, and you'll see we've listed the interest rates here as SOFR plus 2.5 to 4%, so very positive. And then there's no prepayment penalty. So if you are interested in these, like I said, do reach out to your existing lenders to see if they're a qualified lender, and then examine your current credit relationships to see if it's a possibility. So with that, we'll just move on to the next topic that Holly is going to address on Medicare Accelerated and Advanced Payment Programs.
Thank you, Kayla. So this program is known as the Advanced Payment Program, but more fully the expansion of the Accelerated and Advanced Payment Program for providers and suppliers during COVID-19 emergency. And this program is available for pretty much all Medicare providers and suppliers, whether they're outpatient or inpatient. I'll primarily focus on the outpatient program today, just because that's probably slightly more relevant for most of you on the phone, but there are versions of the program for all types of providers. So this program was initiated on March 28th on a Saturday, and it's an expansion of a historic program. And essentially it's a loan program whereby a provider can say, I would like to get, in the case of outpatient providers, 3 months of Medicare payments advanced to me so that I can have the cash on hand now, knowing that I'm going to have to pay it back later. As of April 9th, $51 billion had been accelerated or advanced on 21,000 requests, and CMS claimed it took an average of 4 to 6 days to fulfill these requests. Now the application for these is incredibly straightforward. Sorry. The application on these is incredibly straightforward and designed to really be able to get the money out of the door as quickly as possible. There's no specified funding cap and no deadline to apply, and you can only apply once during the public health emergency. In terms of eligibility, as I mentioned, pretty much all Medicare providers are eligible, there's only a few exceptions. One, you have to have billed Medicare for claims within 180 days immediately prior to the date of signature on the request form, not be in bankruptcy, not be under active medical review or program integrity investigation, which most MACs and the AMA interprets as TPE or RAC audits, although different MACs are taking different interpretations. And so we've had certain MACs tell us that this would include things like civil investigative demands and other types of investigation, but we think the more logical conclusion is probably TPE or RAC audits. But again, there's no authority on that. And then you can't have any outstanding delinquent Medicare overpayments. So once you receive these funds, you kind of have the cash on hand, and then you start to owe the money back 121 days after the amounts are issued. And so at that point, the MAC will start to take 100% of the claims for the next 90 days, or once the balance is zeroed out, then you'll start to get full payments again. And if you haven't repaid after the 90 days, there'll be repayment on the balance with interest of 10.25%. And that's for outpatient providers. For other providers, the repayment starts after 6 months. And so that's basically it. And with that, we'll move on to the next topic.
Thanks, Holly. And just while we're switching to the next topic, you'll see a map up. This shows you the Medicare administrative contractors that you can contact for that advance payment if you're interested. We're going to talk now, this is Tim Fry, and we're going to talk about the Provider Relief Fund. This is, if I can make a joke on one of these calls, this is the money you received 2 Fridays ago that you were not expecting, the Christmas came in April this year edition. And what this money is $30 billion that Health and Human Services put out from a $100 billion CARES Act appropriations. The CARES Act provided $100 billion for HHS to dole out in grants to help providers prepare for, treat, and diagnose patients that are facing the coronavirus. HHS decided to use this money in a very flexible manner. What they effectively did is determined that $30 billion was approximately 6.2% of their overall Part A and Part B spending in 2019. So they looked across all Medicare providers, doesn't matter specialty, doesn't matter category, doesn't matter if you're a DME supplier or a hospital, but they said, what did you receive in 2019 from Part A or Part B? You get 6.2% of that from this program. And I kind of laughed and joked and called it, kind of Christmas coming April, or for my children, the tooth fairy is real money. They put the money out, they put it in your bank with either HHS stimulus or HHS payment in the payment description, and then they release their terms and conditions that they're requiring of you. They put that up on their website that Friday, and then have been updating the terms and conditions ever since, including some more changes today that we'll talk about on the next slide. This money wasn't targeted. They didn't consider whether you were a rural provider. They didn't consider whether you've seen a lot of COVID-19 patients. There's been a lot of kind of political scuttlebutt behind the scenes that our consulting folks have shared with us. But effectively, they said, we're going to get $30 billion out to Medicare providers as quickly as we can. There is now a pot of $70 billion that HHS has said will be used for Medicaid providers, for unreimbursed care and other expenses. Further announcements are to come. And at the top of the program, Amber talked about the SBA program and Congress including additional funds for the SBA program. Congress is also expected, as part of these negotiations, to provide an additional $75 billion to HHS. And so HHS will now have a significant pot of money, the remaining 70 plus, if this money goes forward, $75 billion from the CARES Act fund, the second CARES Act fund to use in different ways. But this $30 billion is in your hands today. That doesn't mean it's string-free. HHS has now put out an attestation portal that's been open since last week. It includes the terms and conditions. It also includes what HHS thinks you should have been paid. So it is worth logging on to the attestation portal, putting your tax identification number into the system to see how much they have in their records, just to square it with what you actually received. But you do not need to take affirmative action today. HHS has said that at the end of the 30 days, they will deem you to have attested to the terms and conditions. They will deem you to have attested to the program. And therefore, you don't have to jump up and down and do it now. If you want to see if HHS is going to provide more guidance, as they have been, you can do so, and you can wait and let the 30 days kind of run. A few things in the terms and conditions. The first to point out, and this has been something that has evolved, it needs to be used, you're going to have to certify that you provided or provide care after January 31st to diagnose, test, or care for individuals with potential or actual cases of COVID-19. HHS has said they consider potential cases of COVID-19 to mean anyone. We are all potential carriers of COVID-19 in HHS's parlance. And so therefore, what seemed to be a very narrow certification initially when they put their documents out, and that is required by the CARES Act statutory language, they've tried to broaden through their website. Second, you're going to need to certify that the payment is only to prevent, prepare for, or respond to COVID-19, but that you can use it for healthcare-related expenses and lost revenue. To date, HHS has not explained what they mean by this. They've left it very broad and open-ended. And we suspect the reason for that is that they didn't want to limit what the uses were to exactly what Congress said or anything they would state, and then have you say, well, it's not in the list, it doesn't get included. Congress had some very specific statutory items that could be used, like constructing a new facility or expanding your workforce, kind of surging to COVID-19. HHS has seemed to be worried broader than that for providers, that so many elective procedures have been canceled, so much lost revenue, and therefore they wanted to come up with additional ways, and this money was to go for a very broad set of things. So you're going to have to report to HHS. Those reports may become public, so you don't want to use funds in a frivolous manner that could lead to, kind of public shaming. But you should, at least as we understand the program today from HHS, have wide discretion. Two last things to just check on, and then we'll shift to final couple topics so we have time for questions. First, as participants in the program, you cannot balance bill, and on the slide we said possible or actual cases of COVID-19. That language today was changed in the terms and conditions after we finalized these slides. It is now actual or presumptive cases of COVID-19. And so that's important because what I said before, everyone can potentially be a COVID-19 case for eligibility purposes. Now that we know balance billing is prohibited just for actual or presumptive cases, we think the balance billing prohibitions are quite narrow. They only apply to patients that you think have COVID-19. The final thing I'll just point out here is, while I said that there was probably broad abilities to spend, there are a number of HHS grant requirements that'll stop you for using it for certain purposes. One that's on this slide is that you can't compensate highly compensated individuals. You can't use it to pay them above $197,000 a year. You also can't use it for networks if those networks do not stop pornography. You can't use it for abortion or lobbying or working with the ACORN organization. So there are some political reasons you may not be able to use spending. Terms and conditions are about 10 pages long, and so if you have questions about that, we'd be happy to talk. Before I turn it to tax, the last thing I just want to spend 2 seconds on is Medicare payments. The CARES Act makes some tweaks to Medicare payments, especially for hospitals, with an add-on payment for COVID-19 patients, but also delaying DME and lab payment cuts. It also, for all providers, helps with the Medicare sequestration cuts that are about 2% this year. On the back half of this year, they'll be suspended. There's also a number of telehealth changes. So if you're of interest of any of those, our team would be very happy to discuss. With that, I'm going to turn it over to Gerald to kind of cover some of the changes in the coronavirus legislation with respect to tax provisions.
Thank you, Tim. This is Gerald Thomas speaking. So with the last few minutes, let me just cover a couple of the tax items that were mentioned at the beginning of the presentation. First, as many of you know, one of the provisions that was inserted in the CARES Act allows for employers and self-employed individuals to be able to defer the employer's portion of the Social Security taxes that are due from March 27th, the date of enactment, through December 31 of this year. With that deferral, 50% would be payable by December 31 of 2021, and the remainder is payable the following year of December 31, 2022. Now, at the beginning of the presentation, Amber had mentioned the interplay between the PPP Forgiveness and the deferral of Social Security taxes. Just wanted to clarify, because this is one of the areas where the CARES Act terminology was not exactly clear in terms of how you would deal with the forgiveness of a PPP loan as well as taking advantage of the deferral. Just last week, IRS released guidance to clarify the interaction between these two provisions. And under that guidance, it provided that an employer that receives forgiveness of a PPP loan and also had deferred the employer portion of Social Security taxes prior to that forgiveness would be able to continue the deferral on those amounts through just as I mentioned before, through the end of 2021 and 2022. However, that employer would not be eligible to defer future Social Security taxes and that were incurred after the forgiveness date. So that is something that was clarified just last week, and this is very taxpayer favorable in that it does allow taxpayers to essentially be able to defer their employer portion of Social Security taxes until they actually receive notice that their loan, their PPP loan, has been forgiven. On the next couple of slides, moving to the discussion of the employee retention credit. This is a refundable credit against the employer's portion of Social Security taxes and is equal to 50% of the qualified wages, which is defined and we'll discuss later, 50% of the qualified wages of each employee in a calendar quarter. And note that the annual credit is capped at $5,000 per employee. The first thing I would like to mention here is that if employers receive this credit, they are not eligible to receive the PPP loan. That is one of the criteria that we mentioned at the beginning. With that being said, the credit is only available for the calendar quarter in which either of two things occur. The first is that an employer is eligible for the credit if its business operations were fully or partially suspended due to a government order limiting commerce, travel, or group meetings due to COVID-19. The second aspect of the test, which an employer may avail itself of the credit, is essentially where the employer's gross receipts are less than 50% of the gross receipts for the same calendar quarter in 2019. So essentially, an employer would have to compare its gross receipts 2019, let's say second quarter 2019, compared to gross receipts in 2020. And once the employer has satisfied that test, it's able to take advantage of the credit until a calendar quarter in which its gross receipts are greater than 80% of the gross receipts for the same calendar quarter in 2019. So essentially with these two tests, the employer can determine whether or not it's eligible for the credit. A couple of things to highlight here, and where we're getting several questions from our clients. It's first with respect to the business operation being fully or partially suspended. Just want to clarify there that it does need to be with respect to a government order. If the business just voluntarily decides to suspend its operations in keeping with CDC guidelines or just as that employer views as best practices, it will not be able to satisfy this test. And instead, in that situation, presumably an employer may be able to satisfy the gross receipts test in terms of determining eligibility. Next slide. So at the beginning, I mentioned that the credit is based on 50% of the qualified wages. So what are those? Qualified wages are defined as being wages for tax purposes that are paid between March 13th of this year and the end of the year. Plus certain qualified health plan expenses also get tied into that definition. As I mentioned, the cap of qualified wages is $10,000 per employee, which, as I mentioned, the 50% of the $10,000 comes out to be $5,000 per employee for the year of credit. In determining what wages are picked up in this definition, an employer has to look at the average of its full-time employees. And the threshold is 100 employees. If the employer has an average of more than 100 full-time employees in 2019, then the wages that get picked up in this definition are those wages that are paid to the employee while the employee is unable to provide services in the calendar quarter, depending on which test that particular employer satisfied. That is either the 50% gross receipts test or the COVID-19 government order. And if the employer has an average of 100 or less full-time employees in 2019, then you only look to the wages paid to an employee in the calendar quarter in which it satisfied those various tests. Something to pay attention here that's a little unclear, and that is taxpayers have asked, what if their employee was full-time but is now being furloughed and it's only maybe working part-time? Does that employee, can you qualify those wages as part of receiving the credit? And there's some unclarity there. If you look at the IRS website, the frequently asked questions, their response there suggests that an employee, that you'd be able to take a credit with respect to the wages for that employee for that portion of time it is not providing services. But again, that's an area we would want to see further guidance, because there are some views that an employee, that you're only able to receive a credit with respect to wages for an employee if it doesn't provide any services through the calendar quarter. So again, just something to keep an eye out for. So with that, I want to make sure that I just give time for questions and answers. The tax areas can be very, very complicated, but this, again, we were just trying to give a high-level review of these items. So with that, I'm going to turn it over to Kayla.
Gerald, this is Tim, actually, and I'll take it. Thank you so much, and thank you all for joining. So many great questions. We're trying to answer many of them, if we can, kind of personally as well. And of course, we're going to do our best to respond to you if we can't in the next 8 minutes. Feel free to also reach out to all of us on LinkedIn or by email. We'd welcome that. I'm going to first turn it to Amber, where Amber, you were getting some questions, I think, about health benefits within payroll and in the forgiveness of the PPP program for those that have received funds. Amber, do you want to take that question?
Sure, absolutely. So I've had several questions about the PPP forgiveness component. I'm not surprised that that is sparking particular interest right now, given the stage that we're in. One of the questions that we had received was whether or not the employer portion of health benefits could be included in the calculation of payroll-related expenses during that 8-week period of forgiveness, and the answer is yes. That is allowed and eligible to be included as a forgiven expense.
Great. Thank you, Amber. And a couple questions have also just come in terms of operationally, will these slides be emailed or available? Yes. My understanding is our tech team will be sending those as part of the thank you communication here. Also have received some questions on the HHS program about reporting at this time or record keeping. Hey, what should we be doing? And I think currently HHS hasn't put out what their quarterly reports are going to look like, but we expect that to come before the first quarterly report is due in June or July this year. In the meantime, we'd strongly encourage providers, like what Amber said about the PPP program, make sure you're record keeping each dollar. Some providers, that may make the most sense to kind of set up a separate account or at least a ledger, kind of making sure you're accounting for each dollar you're spending. Obviously, if you have a more sophisticated accounting system that will let you kind of finagle things so that you can generate reports, so you can calculate your estimated lost revenue, all of that is wonderful. But right now, just kind of record keep track of each cent, and more should be coming. Gerald, I know you got a chance to see some of the questions. Was there any of the tax questions that you wanted to take now, or should we go ahead and take another PPP question, Gerald?
Why don't you go and take another PPP question, and I'll be sure to respond to the tax question offline.
Great. Amber, I know there's been a number of them. Is there another one you want to respond to?
Sure. Here's one that has come up in a couple of different contexts from a few different people. Recognizing that in the PPP discussion, I mentioned the affiliation rules that are really intended to determine, they are the SBA's approach of determining if a business is small enough to be eligible for the PPP loans. The question came up is, okay, we understand there are affiliation rules for the PPP. Is that expected to be part of the Main Street lending? So this is kind of a crossover between PPP and Main Street lending. And the answer is, as I believe Kayla mentioned, the Main Street lending program is one of the least developed of the programs. These are coming out in a series of programs. Main Street lending has not yet began in the same level of fervor as PPP, so we are still waiting on guidance, but it is not expected to include the same type of limitations on size that the PPP does. It is intended to cover a broader set of applicants for those that have larger employees, larger receipts. So I hope that clarifies that point, but we will certainly be giving you more information as those rules roll out.
And Amber,
Great.
just to add to that, I know we've seen some specific questions about whether or not the SBA affiliation rules apply, like you said, for purposes of calculating that $10,000. Although the Fed has not put out guidance on how the calculation of the employees will work, we do not yet have any indication that the SBA specific rules will apply.
Great. Thank you, Kayla. Thank you, Amber. And one of the questions that came in with respect to the Provider Relief Fund was kind of a question about verifying the amount HHS provided. How do you determine if it's accurate? And I sort of went over this a little quicker than I probably should have during the slides. Effectively, what HHS did is take they took the $30 billion in the Provider Relief Fund. They divided it by the $484 billion that they spent on Parts A and B last year, the traditional Medicare programs. That came out to about 0.06198 or 6.2%. And they multiplied that by every Medicare provider and supplier across the country in terms of what they received in 2019. I think there were some questions that came through that we responded to directly about, kind of, well, doesn't that favor some providers over others? The answer is probably yes. They did not target this in any way. They took what you received in 2019 and they multiplied it by 6.2%. And that's what they sent you on that Friday, or will be sending you by check if you did not have direct deposit. With that, I think we are approaching the top of the hour. Again, want to thank you all for joining. We recognize how valuable your time is, especially these days when you're dealing with such immense financial challenges as well as patient challenges during this time of COVID-19. And we're honored that you joined us today. If we weren't able to get to your question, we'll try to figure out a way to follow up afterwards, and we really appreciate your time. Jared, can you close? And thank you again all for joining us.